and welcome to the latest webinar from Thomas Westcott. My name is Patrick Tigwell. I'm a general practice partner at the Exeter and Tiverton offices of the firm, and again it's my pleasure to be the host for this afternoon's webinar. It's been a somewhat turbulent week, what with statues toppling, crowds gathering, and even the B word, Brexit, has re-emerged. And actually on that, we have had a question, I'll talk more about questions later, but we have had a question on about Brexit and whether the question is on financial and professional bodies and how they'll be affected by Brexit and the possibility of a no deal. The answer to that is, unfortunately, we just don't yet know. So apologies, we can't yet answer that question. It has, though, been a reasonably quiet on the COVID advice front, but there have been things going on. And in a minute, my Exeter colleague, and I think it's fair to say webinar favourite, Chris Hill, he'll be giving us an update on these developments. We'll then turn to the main focus of this week's webinar, which is financial planning during the pandemic and the state and direction of the markets generally. And for that, and representing the variety we have at Thomas Westcott, at least in a follicle sense, you've got Chris's flowing locks there, and then we've got my financial planning colleague, Andrew Brown, who with Ian Andrews, sorry, I couldn't resist, heads up Thomas Westcott Financial Planning. Andrew's based at our Western office, and I would say that any link between the recent spike of COVID in Western and Andrew's family barbecue is entirely coincidental. Andrew will be giving us his take on financial planning and how it's changed during COVID. And as it's a time for many of us to draw breath, he'll also be giving us some basic good practices that all of us should be thinking about. I'm also delighted to welcome this afternoon our guest speaker, Sean Priestley. Now, Sean is a divisional director and wealth manager with Brewin Dolphin. He asked me to refer to him as a wealth manager because apparently they're trying to move away from the stockbroker tag. Personally, I think that's a shame because it spoils my mental image of him in pinstripes, poring over a copy of the FT, looking at FTSE 100 stocks and shares in his mansion in Surrey. But moving away from that now.
Not the case.
And additionally, as ever, we have our head of marketing, Jamie, who's looking after the technology for today's webinar in the background. Jamie is an Arsenal fan, but that's okay, because it does mean we can tick another diversity box at TW. The webinar is recorded, and Jamie will email this out to you afterwards. So that's it. That's the sort of intro. What's the plan? Well, we've allowed an hour for this webinar today. Chris will give his update in a minute, and if you have any questions on that, we can attend to them then. I'll pass it over to Andrew and then to Sean, and then we'll have time for questions afterwards. We've had lots submitted during the registration process, so that's great. But if you haven't yet submitted a question, don't worry, you still can. Use the Q&A button down there. We'll try and answer as many as we can on the call, but any we don't get to, we'll answer afterwards. And if you're a client of the firm, it could be your regular partner will answer those. As always, if you'd like to remain anonymous, just put "anon" at the start of your question. And do remember that, as ever, we can't necessarily answer detailed questions about your personal circumstances, at least on the call. We'll leave that till afterwards. If we get to the end of the webinar and you'd still like to ask a question, you still can as well. Use the email address events@thomaswestcott, all one word, .co.uk. So that's all the housekeeping and the intro done. I'd like to hand over to Chris now for his update on the week. So Chris, over to you.
Rick, thank you very much. Well, here goes the technology, because I've got 3 slides and we shall see if we can share them across Zoom. Hopefully that is now there on your screen. Yeah, I mean, obviously the primary focus of today is around sort of the financial planning, wealth management side of things. But we do always use these as a good opportunity just to get an update out there in terms of what the sort of key developments on the COVID support measures that are out there this week. So today I'm going to focus on 3 areas. There's going to be the job retention scheme, or more technically, job retention scheme version 2. We've got the self-employment income support scheme, and then we're looking briefly at the grants scenario, the grants that are being distributed via the local authorities. So moving on to, this is where the technology goes wrong. Moving on to the first of those, the job retention scheme. We are talking here version 2. The reason there's a distinction is that the current job retention scheme, which is aimed to support employees who have been furloughed by their employers, and the costs associated with those employees, will cease in its current form at the end of June. We will be moving on to a new scheme with a new set of rules, the detail of which we haven't got yet, and certainly today isn't the forum to sort of try and run through those. It's really just to highlight that there is a change coming up in the job retention scheme. Areas that it will change, I mean, the current scheme is quite rigid. Employees have to be furloughed for a minimum period of 3 weeks. And they cannot do any work at all during that time. That's one of the sort of fundamental principles of that particular scheme. From the 1st of July, that changes. Employees will be able to work on a part-time basis. There will be no minimum furloughing period at all. You could almost get to a situation where an employee could come back for an hour or 2 and then be put back on furlough. So a lot more flexibility around it. Made a note there, and this will be the case. I think just by its nature, if you are involved in doing the calculations for one of these, the calculations of what you can claim back from the government are going to get a little bit more complicated as a result of the nature of the scheme. The other thing with this scheme, the message to get across is that the funding under it is going to be tapering down. So in July, the funding will be as now, in that the government will pick up 80% of an employee's pay, up to £2,500, plus the national insurance, plus the pension contributions that the employer typically will pay on top of that. In August, the government will only pick up the salary costs. The employer will start to pay the national insurance and the pension costs, and that will be a cost to them. And then in September and October, the 80% drops to 70% and drops to 60% that the government will be funding. By the 1st of November, as things stand, the furlough scheme will no longer exist. So it's then a situation that employers will then be standing on their own 2 feet in terms of having to fund the cost of their employees, as they have historically have done. So yes, more complicated. A lot more detail is going to be announced on this. In fact, tomorrow we've been promised this will come out on the 12th of June. So no doubt we will be covering that in more detail in a future webinar. Moving on from employees to the self-employed, they also have benefited from funding from the government. I'm stressing here that this is a grant. I think there is a misconception in certain quarters that this is something that is perhaps akin to a loan and will have to be repaid. It's a grant, and basically it's to fund, it covers the months of March to May, and it's based on 80% of someone's average monthly profits across 3 previous tax years. So at the moment, payments have been made to self-employed people. They continue to be made. The maximum that someone can be paid for that 3-month period is £7,500. just a note there, again, the reason I really just wanted to highlight this in this webinar, if you are self-employed or if you are a partner in a partnership, not everyone has made an application for this funding yet. As you can see there, only about 75% of people that HMRC think could be eligible have actually made a claim. You know, so there is a significant sum of government assistance out there that is yet unclaimed. So if you are in a position where you are self-employed and you haven't made a claim, do please go on the government website. There is an eligibility checker that HMRC have developed, so you can see whether you are eligible or not. That's the first grant that's been paid. People have until the 13th of July to make the claim for this first instalment. After that, you lose any right to receive anything under that first grant. A further grant is going to be made to the self-employed probably sometime in August, and that will cover the months June, July and August, another 3-month period. Rather than being 80% of these average profits, it is going to be scaled down a little bit, much like the job retention scheme is going to be scaled down, and that will be 70% of those average profits. But that, again, is a one-off grant that does have to be applied for. It's exactly the same criteria as the first grant. So you know, if you were entitled to the first one, you're more than likely entitled to the second one as well. So yeah, do check if you're in that position. The third category here is to do with the local authority or funding that's been channeled through the local authorities, really focused on businesses who occupy premises or who own business premises. Over the past few weeks, grants of either 10,000 or 25,000 have been paid out to small businesses and also specifically to businesses in the retail, hospitality and leisure industries. Again, applications are still being accepted. I spoke to 2 clients last week who hadn't made a claim. One wasn't even aware of it. The other actually operates from 2 business premises. They received money for one. Well, actually, you're entitled based on the number of premises you operate from. It's not just one per business. So, you know, there is money again still to be claimed if you are eligible. Quite a number of businesses haven't quite met the specific criteria that you had to meet to get those business grants. So a separate discretionary fund, a discretionary grant, has been made available. And all local councils that I'm aware of, certainly in the South West, are now accepting or have accepted applications for this discretionary grant. Again, it's linked to property. You've got to be in a business where you incur property costs, rent rates, and the like. Now, the government has set some criteria in terms of the sorts of businesses they see as recipients of this grant funding. The 4 I've noted there are people in shared accommodation. So you could be in sort of an office or an industrial unit where perhaps your landlord pays their business rates and you are one of a number of tenants. You've got bed and breakfasts who pay council tax, regular market traders and charities who have charitable business rates relief. Those are the nationally driven criteria. It's called a discretionary grant. Some councils have been using more discretion than others. Some have stuck to those 4 government criteria, and that's it. But then I've got some examples there of a couple of councils that have been more specific on top of the government criteria that they are focusing on in their areas. So in Mid-Devon, tourism businesses, green technology, food, drink and hospitality businesses, and the supply chain behind them. And East Devon, again, looking at supply chain into retail, hospitality and leisure, language schools for some particular reason, and they've also kept it quite open. They also look at any relevant and crucial businesses in their area. So I think the message is, it really is about checking what your local council is doing on this. Look at your local council website, look out for discretionary grants and see exactly what their application process is. Typically, they're only allowing 2 weeks for people to apply. Some of it, in fact, close to applicants, but there are still a lot of local authorities who are accepting applications for these discretionary grants. So that really is my whistle-top tour of the latest updates. So back to you, Patrick.
Yeah, thanks, Chris. I'd just like to, it's something we were discussing this morning, wasn't it? Just a point about the JRS and how, if you could just explain a bit, we've had the 10th of June deadline go past, and you were mentioning that there's a 30th of June deadline for employers. Can you just sort of say a little about that?
Yeah, the way it's, again, we've not had all the detail on this yet, but the way it is looking at the moment is that employers need to have at least made one claim under the existing job retention scheme by the 30th of June to effectively be on HMRC's radar to make a claim after the end of June under the new job retention scheme. So that's something, to be honest, most businesses have been claiming as they go along. There may be the odd one for whatever reason that perhaps are thinking of doing one at the end or something like that. Well, you just need to be a little bit careful in that situation that you at least get a claiming before the end of June. Okay,
yep. Thanks for that. We'll attend to any questions that come up about the update that Chris has said, possibly at the end, but I'd like to sort of move on now to Andrew. He's looking very relaxed there. Andrew, over to you for your take on things, please.
I normally am. Thank you, Patrick, and good afternoon, everybody. Yes, it's odd, isn't it, how we've made the transition to working from home relatively seamlessly, and I'm probably as busy now as ever I am, with the added benefit of not having to commute every day. It's rather nice not having to do that, but I do miss the human interaction, so this is the next best thing, I imagine. So I'm going to spend some time this afternoon actually expanding on a series of short videos I've been doing, and some of you may have seen them on my LinkedIn profile, snappily entitled Financial Planning in Isolation. And the whole idea of it is that we all, to some lesser or greater degree, are having a pause in our lives, an opportunity for reflection. And so I thought it would be good just to sort of go back to some of the real basics of what, as a financial planner, I do. I'm going to start with an even more basic one, which is just to remind you all of the distinction between a financial advisor and a financial planner, because it's often the question I get asked most commonly. And it's as simple as this, that a financial advisor is typically going to look to recommend appropriate financial products to solve specific solutions, whereas a financial planner will tend to look at a client's situation holistically. So we will tend to look at the entirety of their position. And so we get the added level of interest that we can talk to people about wills and long-term financial planning, cash flow modeling, it might be pensions, investments. And the financial products are rather secondary to that process. It's primarily about putting together a strategy that's tailored to the individual client. Those of you that know me will know I absolutely love what I do. I've been doing it for 35 years. I have a bit of an aptitude for pensions. I was originally a farmer in a former life and still live on a farm. But pensions, of course, is very complex. So I decided that if I learned about pensions, I'd probably never be out of a job. And that certainly proved to be the case 35 years on, and I'm still very much enjoying it. So I'm going to give you a bit of a whistle-stop tour to something which at the end of it, I'm going to put up a crib sheet, a bit of an aid memoir. And also we have a pre-prepared handout that we'll send you a link to in the follow-up email. So don't worry, you haven't got to take copious notes, but I'm just going to talk around the specific points that I think will be of interest. Just before I do it, I will frame it by saying that we genuinely have been very busy through this whole process. We've seen very, very few people who've sort of panicked and been sort of selling off investments. In fact, almost none. Vast majority of people have been more pragmatic, and they're looking through this as a very unpleasant but relatively short-lived period of time. And where you have a long-term strategy that's appropriate for you, you stick with that strategy. We've also had a surprising number of new business inquiries, so people who are actually really quite keen to invest in markets whilst they are slightly more attractive in value terms. And hopefully this is something that Sean will bear out. But we have taken a significant amount of new investment over the last 3 months. And I think particularly with interest rates languishing around pretty much zero, with no prospect of them recovering anytime soon, that appetite for investment that can generate a real return above inflation, notwithstanding volatility, is going to continue. So yeah, we are very, very busy indeed. One of the other things that's come as a bit of an epiphany for us, which I'll mention again later on before I finish, as we are introducing a new service at Thomas Westcott, snappily entitled Business Resilience and Protection. And it's something that's specifically geared towards the increasing appetite we're seeing for business owners really taking stock of their position and trying to future-proof themselves, that if ever this sort of thing happens again in the future, they're in a better position than perhaps they are at the moment. And this is that time to reflect, to put things in place so that if ever it does happen again, it won't be quite such a painful process. So without further ado, I'm going to kick off with some of the really basics of financial planning. And one of the ones that I often get asked about. The first one is the Ken Dodd financial planning angle. The Ken Dodd one. Anybody know that one? Well, basically what it is, you marry your significant other 3 days before you die. He did it and it saved his family about 3 million quid. Why? Well, unfortunately, it's because the tax system is still very much skewed towards cohabitees in favour of those who are in civil partnership or a marriage, in that you have things like transferable nil rate bands for inheritance tax, incredibly valuable. The ability to transfer assets for capital gains tax purposes without giving rise to an immediate tax charge. All sorts of benefits from a tax perspective. Aren't I romantic? Wonderful romantic. From a tax perspective to getting wed to your significant other. So again, if you're reflecting, you're thinking about things, maybe now is the time. If you want all those lovely tax benefits, talk to one of the financial planners at Thomas Westcott or your normal Thomas Westcott contact about benefiting from all those lovely transferable reliefs. Interestingly enough, we work, of course, with a lot of lawyers, and we are fully expecting, as we get through the other end of this, to have an increasing amount of matrimonial work. We suspect that the pandemic may bring an end to a few relationships, and of course, we do work on valuations. We also get quite heavily involved in the technical side of pensions and divorce, and we also suspect there'll be an uptake in demand for people wanting to do estate planning for obvious reasons. So that's the first one, marry your significant other. The second one, it always amuses me that people perhaps are not necessarily aware that provided they're properly structured, their pension assets don't form part of their taxable estate for inheritance tax. So one of the things I'm often asked to do, and again, really important that if you've got time to do it, you do it now, look at your existing pension arrangements. And if they're more than 5 to 10 years old, it's highly likely that they won't comply with the new pension freedoms. So a lot of what we will do will involve updating them and consolidating them into something that is both accessible flexibly and transferable to your family when you die, in a way that wouldn't be the case if you have an older pension arrangement. Part of that process is nominating those death benefits, because once you've got your pension assets outside of your estate, your will isn't relevant to them. So you have to have, if you like, a will for your pension fund, and it's known as an expression of wish. One of the things I often find quite funny in my job is I get an instruction from a new client. I find that he or she was divorced 10 years ago and that they've still got their pension benefits nominated to their ex-wife. Not at all uncommon to see that 9 or 10 years later. So a very good point for all of you, go and check the nomination of your pension death benefits. Either if you haven't nominated them at all, or if you have done, just make sure it's not still to your ex-wife or ex-husband. So keep the nomination updated and make sure you update the arrangements so that they can be transferred to your family members when the time comes. So that's my next tip. Writing life cover in trust is a really easy one. Again, it's so common for people to have life insurance, but to not go the extra step to fill out that awful trust deed. It might be a bit of a pain and a bit of a chore, but it really makes a difference. If you don't write your life policies in trust, then you risk the value falling into your estate for inheritance tax purposes, but more particularly for probate purposes. So if you write the policy in trust, and I've seen this dozens of times in my career, you could get the money in the event of a claim from a life company to the intended beneficiary within 4 to 6 weeks. If you don't write it in trust, it could be 18 months or longer. As simple as that. The trust forms are free. They're normally available from the life companies. If you need help, we can help you. But for goodness sake, make sure your life policies are all written in trust. The next one is a bit left field. It was an idea that came from one of my partners, and I think it's brilliant. It's simple. Record your online life. So for example, if you're going to be beamed up by a spaceship tomorrow, does somebody know all of your login details, all of your passwords, all of your usernames, even the websites that you use, your online shopping, for example, your bank account, your online banking facility? You need to record it. Of course you need to record it securely, but somebody needs to know where all of that information is, because if you are beamed off the planet tomorrow, chaos could ensue. And the more reliant we get on the new technology, and we are now heavily reliant on it, and thank goodness for it, otherwise we wouldn't be doing this today. You need to make sure that your online life is recorded so that somebody can untangle it all if you're not around to help. So record your online life. Well, this will come as a shock to you. Those of you that are pausing for thought, have you got a valid will? It's amazing the number of people that we talk to, even lawyers of this parish, that don't have valid wills. It's very simple. If you die intestate, it's a bad idea. Intestate is the technical term for dying without a valid will. It's not going to end well. It's going to make it much more difficult for the people you leave behind to sort things out. And potentially there's a default process under intestacy rules, especially when there are children, which means that assets won't necessarily pass in the way in which you want them. So for goodness sake, make a will, a valid will. If you need to go to Smith's and get a pack and do it yourself, that's fine. It is possible to change a will within 2 years of a person dying using something called a deed of variation, and the lawyers watching this will know that only too well, subject to the agreement of all the adult beneficiaries. But it's better to have a will, even if it's a simple one, than it is to have no will at all. It can be created retrospectively, but it's much more difficult, much more expensive to do that. So make sure you maintain valid wills. And in fact, in the current tax environment, they can be really simple wills, and they should be really simple wills. In a couple scenario, leaving everything to each other and then on to the children, or as they're known in legal speak, lineal descendants. That way you get the maximum relief for inheritance tax, the additional residence nil rate bands as they are called. Very important though that your will is appropriately worded. And sometimes you might have an older will that hasn't been reviewed for a few years. It might contain trust provisions that are no longer needed. Nil rate band trusts are very common. So if you've got a will, dust it off, review it. If you haven't got a will, make a will. If you want some help from us, some guidance, we'll be delighted. We'd be very happy to talk to you. Moving on from that, I've just mentioned it in passing, but I'll reiterate the importance of it. Make sure your will is inheritance tax efficient. Make sure too that if you have business interests, your will deals with those business interests, that it ensures that they are properly considered and that there is a clear path. And a really, really simple one I'll come back to later is the old letter of wishes. But the will has to be drafted in a certain way. And actually, it's simple, relatively simple format in order to benefit from the full allowances from inheritance tax that can be claimed by your executors. If it isn't, they won't be able to claim them. It's as simple as that. Creating complex trust arrangements is a good example, whereby there may be good reasons for doing that, but it might also mean that you can't claim the allowances. And also, just as an aside, those of you that have business interests, if you have a trading business, one of the attractions of keeping a trading business throughout your life is that it is normally not subject to inheritance tax. That is true, but it is not exempt from the cumulative inheritance tax calculation. So just be mindful of that the rules are a bit more complicated than just saying, oh, my business interests will never be taxed. It's not quite that simple. The next one is really obvious. Maintain a schedule of your assets. It's a really basic thing that every financial advisor will ask you to do. First thing they'll ask you to do is your assets and liabilities in a simple Excel spreadsheet, and your income and your expenditure in another. If you haven't done that, how on earth do you know where you are? It's amazing the number of people don't really know what their annual expenditure is. And it's a brilliant discipline, we're told by our clients. They might bemoan the request when we send them the form, but they sit down with a big pot of coffee and a template that we give them, and they get their bank statements and their credit card statements for the last 12 months, and they detail exactly what they've spent. Really useful to do that. How can you plan what income you're going to need in retirement if you don't know what your lifestyle costs you? You also find in doing it, it's a very cathartic process because you'll find lots of things, the gym membership you never use, the Netflix subscription you never use, all those horrible things you're paying for that you've never cancelled, and the direct debits and so on. I've saved a fortune over the last 3 months. My outgoings have absolutely tanked for all the things I've been paying for the last 3 years that I've forgotten about. And that's the financial planner speaking. So maintain a schedule of your assets. Make sure that your executors, your spouse and partner know where everything is. Keep it up to date. Keep a record of any gifts that you make during your lifetime. Keep that with your will. So just create a simple audit. It doesn't have to be complicated. But the basics, where is the asset? If there's a reference number, roughly what it's worth, who owns it, that sort of thing. Just keep a simple schedule of your assets. One of my next favourites is tax-free life cover. I love tax-free life cover. My accountancy colleagues particularly like it. This is something that a lot of business owners are not aware of. If you operate your business through a limited company, there is an HMRC concessionary form of personal life cover called a relevant life plan. What it does, it provides you with potentially a very high level of personal protection, but the company can pay the premiums, they're allowable as a business expense, and they don't give rise to a P11D benefit in kind. So it's tax-free life cover. So if you're paying for your personal life cover yourself, or if you're paying via your company but not via a relevant life plan, and you're therefore suffering a P11D, which my accountancy colleagues will have to tell you, then change it. Set up a relevant life plan. They're simple, they're inexpensive, they do have to be medically underwritten, and they do have to be written in trust. So if your health is awful, you probably won't get cover, but if your health is reasonable, you almost certainly will. It can be a very high multiple of your income. It's not uncommon for us to do between 250,000 and £1 million of cover. The premiums are in the sort of £30 to £50 a month bracket, and it's a great way of getting some value out of your business over and above pension contributions. And as I say, it's tax-free. So take out some tax-free life cover. The next one, and you're all going to groan at this, for goodness sake, appoint an attorney. If you haven't got an attorney, appoint one. Just because you're married or in a partnership, you'll assume that the other person can just pick up the cudgels if you get a bang on the head or you suffer a sudden illness. That is not the case. Lasting powers of attorney were introduced in 2007. They're incredibly robust, they're incredibly useful, but they don't just happen. You have to appoint an attorney, you have to register that attorneyship with the Office of the Public Guardian. It's not the cheapest thing in the world to do. It'll cost you several £100s. It's not the quickest thing to do. It will typically take about 4 months to complete. But without it, you really do risk the continuity of your business or your personal financial affairs if you don't have an appointed attorney. Trust me, they're robust. The attorney can't do anything unpleasant or illegal or anything that would in any way benefit themselves. If they do, they'll have a long term in jail to think about it. So, of course, you need to pick them carefully. It won't necessarily be your spouse or partner. It might be a contemporary, a peer, a trusted friend. It might even be a professional advisor. But it's really, really important, particularly if you have a business and not just if you're a single individual, that you appoint an attorney to deal with your property and financial assets, and also potentially your health and welfare requirements if appropriate. Again, something we can give you help with and some guidance and point you in the right direction. The final one is an old favourite of mine. It's a letter of wishes. I love letters of wishes. So both in regard to your pension assets and in regard to your will, for goodness sake, write a nice letter of wishes to your family. Because bear in mind, if and when the worst happens, and it's when, not if, you're not around to ask questions. So what happens is we get the phone call, there's your accountants, your financial planners, we sit around the kitchen table. Well, what would Dad have done? Well, I don't know. You need to write a letter of wishes. Make it as clear and detailed as you can. It's not a legally binding document, but it's something that invariably everybody will follow and be incredibly grateful for. So write one, update it every couple of years. You can stick it in a sealed envelope if you want. Keep it with your will. Make sure somebody knows where it is. That's kind of my list. That is my list. I hope you like my list. I'm going to stick it up so that you've got the aid memoir. With my terrible eyesight, I have to get close to the screen. So I'm sharing my list. So there you go. That is the list. It's not exhaustive by any means, but hopefully it's thought-provoking and I've given you a flavour of each. And I will just mention in passing, over and above the will of the list of things we talked about, that we have a leaflet which was originally called, the working title of this was the Kick the Bucket list, but I was overruled by my colleagues that they didn't think that the Kick the Bucket list was quite the right tone. So we've slightly dialed it down and called it a lifetime planning checklist. But we hope you'll find it useful. You will get a link to it in the email that you'll receive after the webinar. Have a look at it and hopefully it will act as an aid memoir and it will prompt you to take some action whilst you have this hiatus in your life. You have a little bit of time to think about things. As I say, we're seeing a significant increase in inquiries from clients who are looking to do exactly this, financial spring cleaning. Update your pensions, massively important, and your wills, and your powers of attorney, and your life cover. Now is the time to do it before everything gets back to normal and it all gets forgotten, as it inevitably will. And the final parting shot before I pass over to Sean is just a reminder of our new service that we'll be launching in a couple of months' time. Business Resilience and Protection Service. We'll be doing webinars on it, so look out for those. I hope you found this useful. Pass back to Patrick.
Yeah, thank you, Andrew. I'm not sure if you'd like to stop sharing the screen now. That's it, lovely. I'm not sure we have time to have the rest of the webinar because I've got to do my will and sort out my pension with the ex-wife. But I would volunteer to be an online life recipient of your passwords, if that's okay with you. But that's great, and some really good practical steps there. I'd like to sort of move on to Sean now for his take on the markets and where he thinks we're sort of going in this pandemic. So Sean, over to yourself.
All right, many thanks, and sort of thank you to Thomas Westcott for setting up this webinar and inviting me also. This is my first one, so please excuse me if my hesitation or if I go wrong. Essentially, I've got about 10 minutes really, and I've been given some questions, which I will attempt to answer. If I don't get through, I will try and go back individually to the questions that we see and give you a proper answer. I think the reason I'm on the call is over the last 10 years or so, I've developed a very good working relationship with Andrew and with Ian at Thomas Westcott Financial Planning. And as Andrew says, they build a wonderful strategy for their clients, tax efficient wise. And then if it is necessary to invest a portion of that, then they will call upon mine and Brewin Dolphin's expertise to build those portfolios to try and deliver the long-term investment objectives for their clients. And we've been very successfully doing that, as I say, for about 10 years. It works very well with complex clients, particularly with pensions. And in these day and age, drawing an income, it has become more complicated, and I will touch on that in my presentation, but I think it's very relevant at the moment. Personally, I've worked at Brewin Dolphin for 12 years. I have loved markets, and I've been involved in the markets for about 25 years. I'm quite a weird person. My granny bought me a book on the stock market when I was 5. So I've always had a huge interest in it. So again, I'll try and use some of that knowledge and experience to answer the questions. One of the questions I'm asked, particularly over the last month or so, is, how can markets be going up given where we are in the situation and the economy? I'm afraid we're going to have to go back to school a little bit on this one, but I think it goes to understand the key drivers of markets. There's 2 key drivers. There are plenty, but the 2 key ones. One is mathematics, fortunately for me, and another one is emotion, which I think fear and greed, which makes it, really, really interesting. So, mathematics, when I'm buying Unilever, today it's at £43.50, what does that £43.50, what constructs that amount of money for the share price? And what you've got is a long-term stream of profits. So 20 years is often cited. And then you discount that back to the present day using a discount factor. I don't know whether you remember your net present value calculations at school. But an important part of that is profits, obviously. And 20 years is a long time. And the other important part is the discount rate. So I will come back to that. The other driver is emotion. Fear and greed is often cited, and we've seen both of those recently. And I think it's an interesting commodity. We say share prices are probably one of the only commodities that as the price falls, people become disinclined to buy it. So, in March time when the markets was bottoming, fear was driving people's decision making, and they weren't buying when, that's historically is always the best time to buy. And this is why I've got a job. We're dispassionately timing the market and picking value for clients and trying to take this fear and greed out of the equation. So let's sort of, I'll try and share my screen. Apologies if this doesn't work. But let's try and use this what I've said in sort of what's happened year to date. So can you see my screen? Can anyone see the screen? Yeah, okay. Well, this is the FTSE 100 year to date. So we started off the year, everything looked quite positive. China and the US were getting on a bit better. We had a stable UK government, and we were in a reasonably positive mindset. And then unfortunately, COVID hit. The market then had a huge dive, as you can see. And really, again, this was one of the most volatile periods in the market history. The VIX, which is an indication of market volatility, hit its highest point ever since inception. And, you know, we saw 10% plus falls in the FTSE 100, which is something we didn't see, you know, during the financial crisis, which is often cited as the last real horror. And within, you know, it took 18 months for the financial crisis to go from top to bottom. Whether or not we're top to bottom, you know, in 30 days, we went from 7.4 to 5.49 in the FTSE 100, which is a huge sort of bear market, really. And again, we saw these huge falls. So, you know, another question, sort of a question, is where we are. You know, what stopped that fall, and why did we see the recovery? As you can see from that the chart, the G7 special announcement, the G7's the top 7 economies in the world. They basically said they were going to do whatever it takes to promote strong growth, not just growth, but strong growth. And boy, have they sort of thrown the book at this. They sort of the kitchen sink has been thrown at this. I think they learned their lesson from the global financial crisis, where they were slow to go in and it created more problems. They've really been extremely proactive. Now, I've done these sort of presentations, as you'd imagine, and April it was 5 trillion, which is a huge sum. You know, May it was 7 trillion, and now in June it's 9 trillion. And I've heard talk it goes up to about 20 trillion if you include all of the guarantees they've offered. So, you know, with global GDP at 80 trillion, you know, this is a sizable sink being thrown at the problem, and I think has been a massive reason for the market turning around. The other thing is obviously an improvement in Italian and Chinese case rates. They were the first ones sort of in, and as their case rates improved and we've slowly opened the economy, you know, the market has rallied sort of very strongly between April and May. And I think, you know, this is rallying through some of the worst economic data we've ever seen. You know, this is the worst recession since World War II. You know, we had the Fed come out yesterday and predict 10% unemployment in the States. They went from a 2% GDP prediction in December to a minus 6.5% one. So, you know, one of my clients lovely asked me if we'd considered, you know, a US recession. You know, yes, the market does consider all of this, but, you know, what the governments have done is carried, you know, the people were worried about companies going bust, but they provided the liquidity so people can now look through the market, and we've seen a strong rally. And then, of course, going on the emotional front, you know, we've gone from fear, you know, once you look through this period and start looking 3 years out when things should be hopefully back up to normal, you know, they start feeling greedy and they get buying, and again, that money comes in and pushes the market up. So that's sort of brought us to where we are now. Again, a question I'm often asked, which is very difficult to answer, is you know, what's going to happen going forward? And I think it's never been as uncertain as it is. I think the key thing that everybody's looking at is really, you know, the economic data has bottomed. We're starting to see better industrial data. It's sort of recognised that maybe April, in the middle of the lockdown, was the worst month, if you like, for this, and we're seeing improving data. Markets love improving data, and that's another reason why it's moving up. But then again, on the negative side, you know, everyone's afraid that this increased economic activity is going to spark a second wave. I think everyone expects a second wave, but it's just how much of the economy you can get going through that, and whether or not it subsumes the health service. So that's a key thing the market's looking at. The other thing is, as I said, there's been such a massive amount of stimulus, you know, which will continue. Interest rates are historically low, as Andrew said. You can't use that for income now, and you know, that is part of this discount factor for markets, because if your interest rates are lower, you know, but I did see some research that said the market should be higher because long-term interest rates are so low. But then, so you've got this that should help turbocharge a recovery, but you've also got, you know, this stimulus is increasing debt on everyone. That's particularly governments, but also companies and personally. You know, are we in for a period of long-term austerity? Will taxes have to rise? All of these things are sort of trying to be dictated or sort of considered in this equation. And you've also, you know, whilst valuations have improved, you know, we've gone from 7.7 at the beginning of the year to 6.2 in the FTSE. You know, some people think they should be a hell of a lot lower, and you know, we're not pricing in enough of this uncertainty. So, you know, it's as a house, you know, and for my clients and Andrew's clients, we are pretty positive over 18 months. We feel that the quality companies that we invest in will survive and thrive. Good companies with access to capital tend to grow market share through in periods of volatility. Smaller companies and poorer companies tend to lose that. But mindful of this shorter term potential for volatility, we have increased cash levels because we do, you know, this chart shows the end of 6472 there. Today it's at 62 because the market's, you know, it's come back again. So we are incredibly volatile. We're trying to be agile and pick up bargains, basically. I can see I'm running out of time a bit, so I'll clack on a bit. Last question I was asked is, how do I get a decent income from these investments? So I'll just put a chart on. Is it on? No. This is a long-term chart of interest rates. So it's long-term interest rates is the orange on the orange line, and long-term inflation is the blue line. So as you can see, interest rates have gone well below inflation. So again, as Andrew said, this has forced people really to take risk to get income. You know, there's no, the days of getting 5% income from interest from the bank are gone, and we've seen a lot of clients coming to us because their cash interest has gone down, and we've been successfully providing that income for Thomas Westcott clients. It's become more difficult recently. There's been a huge, if you go for dividend paying companies, they've underperformed massively to, you know, the market's over the last 3 or 4 years. Market wants tech and growth. And if you're holding these income payers, you've suffered underperformance. And also COVID has come along and just slashed dividends. Like the UK market is predicting a 30 billion loss in dividend income this year. So again, much more difficult to produce income. What we're doing successfully is managing a more of a total return strategy for clients. And this has been going for a number of years. Where we have more of a growth and value sort of bias. We may produce sort of an income of say 2.5%. So if someone wants to take 4 or 5% for their standard of living, what we do is we have a good natural income flow, and we top that up with regular capital disposals. So over the last few years, we've been taking profits in the US and equity. During the last few periods, we've potentially been selling some gilt exposure or US treasuries, which have performed really nicely. So again, we feel this is a real sustainable strategy to produce income for people. So in conclusion, you know, markets looking through the uncertainty a little bit, but are very volatile. We are positive on an 18-month base, but we are mindful of shorter-term volatility. And we just feel that this diversified sort of total return strategy, again, provides a robust income-producing portfolio. So back to you, Patrick. Thank you.
Yeah, thank you, Sean. That's really useful.
I'll stop sharing, sorry.
Yeah. Sharing is good, but not all the time. If I could come to a few sort of specific questions we've had then. Now, obviously these might be for either one of you, Andrew or Sean, so if the other one wants to step in at any point, do so. Firstly, we've got a question from Diane, just worried about how hers and her husband's investments have fallen recently. Now, what would be is it basically a case of sticking it out if you don't need the money, you know, at the moment? Sean, what would you say?
Yeah, I mean, composure is, as I'm sure Andrew will agree. And one thing, you know, as I say, we've had more clients, you know, you have to take risk really to get a higher return at the moment. That's accepting capital risk. Most studies of the market show that, you know, you have to hold on through periods of stress. And we saw this, you know, and speaking to clients during March, you know, when everybody is afraid, you are not going to get good value. And you need to sort of, there's many studies done saying, you know, I think the first quarter was the worst quarter on record, and the second quarter started out as the best quarter on record. You know, you had this huge sort of rebound. So yeah, you have to have this composure. You know, hopefully when they went into these investments, it was explained that volatility is the potential, and you know, you have to hold out really. So, you know, I think if you have a diversified portfolio, you know, you're probably sat, you know, about level from where you were last year, amazingly. So I mean, it's all about setting that risk, and this is what Andrew incredibly well, sets people's expectations, sets people's risk, so that they can weather this sort of, if there is volatility, and ride it out. Sorry, do you think that's sensible, Andrew?
Very much so. It's a tremendously good time to be saving on a regular basis. I mean, we have some clients that are looking to invest fairly substantial sums of money, and they might be investing £1,000 a month rather than putting the £10,000 in all in one go. They're investing on a significant amounts on a monthly basis, so they benefit from what's called pound cost averaging, which means you average the acquisition cost of the underlying investment. So monthly savings is a good way. We can also phase in lump sums for clients if they're investing. When we're working with Sean, he'll very often take a capital sum, but he'll phase it in over 3 or 6 months, looking for value and benefiting from the volatility in markets. But if you are fully invested, then yes, you made a good comment yourself. If you need the money tomorrow, potentially it might be a problem, but as long as you've got a reasonable time frame ahead of you, and particularly if you're not looking to annuitize your pension fund, then sit tight, leave it. If it was right before, it'll be right now, and it will come good. It's the very nature of it. It's a natural part of investment in risk assets.
Okay, thanks, Andrew. And building on that, a question from Roger. Can the panel recommend income-producing investments that have been hit by lockdown but are potentially good prospects for the recovery and the bounce back? So, what would you guys think to that? Sean, what would your view be?
I think, I talked about income briefly. I think I can't advise anybody because I don't know their circumstances, but I can say what we've been doing in portfolios. For natural income, we've been looking at sort of alternative property, healthcare, REITs. There's supermarket REITs, which do internet delivery. So that's in property income vehicles. There are UK investment trusts, sort of UK equity, which have dividend reserves, which we've been using for some life interest trusts. And there's also an interest in sort of renewable energy sector, farms and things like that, which pay, there are some investment trusts that invest in those, which pay quite nice income yields. I think sort of what's come back is probably financials and have continued to pay yields. But again, they're risky because obviously they're very geared to the economy. But we have seen sort of Legal and General and Phoenix pay dividends despite the falls. But you are then subject to high degrees of capital risk. So, it's not something to go in, on a very, we like a nice broad mix of these things and specific risk on companies. So definitely discuss this with Andrew. Don't just go to Hargreaves and pick up some of these things. But
it's a very good point. The clients, our experience of a lot of clients who attempt to self-manage their finances is that an awful lot of them have caught a massive cold. You really do need some expert advice. It's not something to skimp on. If you try and do it yourself, you're going to get it horribly wrong.
I think in this period, banks, if you had a period of, banks, oils and, property REITs, that could be, you would have been badly hit in the last 3 or 4 months. And
just another question from Michael. It's about 4 questions in one, really, but he's saying about whether we should be holding cash, gold, equities, US overpriced, he's saying, but are they a buy now, or UK growth problems a sell? So it's obviously talking about what kind of mix of assets you should have in your portfolio. But is there a drift towards gold and cash because of low interest rates and perceived stability of gold and that kind of thing?
Yeah. Gold, I think, is interesting. We did actually add gold. There was a really, as I'm sort of see we're coming to the end, there was a really interesting period where the market ran out of dollars and we saw a big sell-off in the gold sort of towards the end of March, which didn't seem correct given its potential store of value. So we did buy some gold. So the answer is yes, you should have gold, cash, equities. You should also have infrastructure, bonds and everything in a well-diversified portfolio. I think with regard to the US is really interesting. One thing that has come through this crisis is technologies stood out as a really defensive area. So the NASDAQ, which is the US, is actually at all-time highs. It's higher than before the crisis. So, the US the US is made up of these big fangs, you know, Facebook, Amazon, Netflix. So, you know, it seems weird, but as the news gets worse on the virus, they tend to go up, and then the more traditional stuff comes off. So, you know, I think it's sort of have this even spread, because the market is whopping around like a good one at the moment. I tell you, it's not for the faint-hearted.
Thank you, Sean. I'd like to address a couple of questions now to Andrew. A slightly different slant away from the markets, perhaps. Firstly, Andrew, we've got a question from Peter saying, should we continue to contribute to pensions when we're both about 70, his and his partner? He's saying that you don't need to take them immediately, but if you're that age, would you recommend? I know it depends on circumstances. Generally, what's
it depends on circumstances. I mean, it depends on, as I say, on individual circumstances. If you're getting a match contribution from your employer, certainly. If you're benefiting from tax relief, especially at the marginal rates, definitely. If you've got a reasonable amount of wealth and you're likely to be over the threshold for inheritance tax, definitely, because you're building an asset outside of your taxable estate. But generally, with the tax benefits on the way into a pension, you get far more on the way in, plus tax-free growth, and then you can draw it out flexibly and tax efficiently on the way out. And if, sadly, your death were premature, provided you've got the right pension vehicle, you can pass it on to your beneficiaries who can access it tax-free, potentially, if you pass before the age of 75. So it depends on individual circumstances, but as a general rule, yes. But keep a lookout for the budget, because we are expecting to see some fairly swinging changes to the tax structure, possibly reductions to marginal rates of income tax, relief on pension contributions. But right at this particular moment, yes. I'd go even further than that. A lot of our clients have got what's called unused relief. In other words, they have the ability to make contributions in respect of prior tax years where they haven't paid anywhere near the maximum, and they can potentially get very significant tax benefits, even refunds, from doing that. So find out if you've got any unused relief, and it's particularly relevant if you've got cash doing very little in a building society that you don't need for immediate requirements. Okay,
thanks. And the other question, or another question, is that how easy would it be for, and this is from Chris Cole, this is, if he wants to move his investments from one platform to another, presumably the current platform isn't performing or is performing as well.
Yeah.
Is that easy? How long does it take? And do you...
Yeah, it is relatively. We do it quite often. Platforms, for those of you that aren't aware of it, they're a fancy piece of software. I call them virtual filing cabinets, because that's essentially what they are. It's just some way to keep your investments. You might have a pension drawer, an ISA drawer, and a taxable drawer, that kind of thing. So platforms are very, very commonly used. We certainly use them for a lot of our clients. And yes, we do occasionally move from one platform to another, very often driven by cost. It's quite a competitive marketplace, and if the sums invested are quite substantial, their charges are normally percentage-based, and so if we can move a client from 35 basis points to 25 basis points, they're going to save quite a lot of money. It's routine for us to do those transfers from one platform to another. You normally, almost invariably, move the client's assets in specie, which means none of the investments are sold. So if they have investments in funds, the funds are simply moved from one platform to another. So you don't have a market timing issue. You just have the sort of inconvenience, if you like, of moving it from one to another. It can be anywhere between sort of 3 weeks, 3 to 6 weeks, something of that order. But as I say, if you're moving the assets in specie, as long as the client's not going to need any money in the intervening period, then you're not taking any market risk. But yeah, looking at the platform, it's a way of potentially saving some costs. And that is something that we do as part of our normal review. Even existing clients, we review them on an annual basis.
Okay, yeah, thanks, Andrew. I'm just conscious of time. Just a couple more questions I'd just like to run through with yourself, Andrew. And I think when we were discussing them earlier, you may not know the answer really, but it's to do with pension funds. Firstly, will the Pension Protection Fund continue to bail out underfunded schemes with greater demand, obviously arising following reduced workforce numbers and lower returns on investment? And I think we were discussing before that we don't really know the impact on those.
No, we don't. I mean, it's funded by subscriptions. I imagine they may be reviewed. There may be a need for larger contributions to be made to make it sustainable, but I can't imagine the government would allow it not to continue in its current form, because it provides a very, very a good service. I just can't imagine that they won't keep it going in some form or another. But undoubtedly there will be an impact, and some deficits will increase. If you have preserved final salary benefits, it's important to keep an eye on the funding position of that particular scheme, but it's relatively easy to get that information from the scheme trustees. They have to publish any deficit and their funding position and any strategy that they have to make good any funding gap. So that information is fairly freely available, but I'm confident that that scheme will continue.
So would that answer the question then from Susan saying, how do I find out more about the future security of my current pension funds, ensure they remain solvent? So obviously the scheme trustees and people like that would have to, sort of produce reports.
Yes, they do. They're readily available.
Yeah, good. Another just a question we had right at the start, really, but obviously completely changing tack and going to you, Chris. So, if you've fallen asleep, now's your chance to wake up. Somebody just talking about the self-employed scheme. If they're self-employed, they're eligible to apply, this chap saying, but doesn't think their business has been affected by a coronavirus. Should they still apply? What do you
Interesting question. There's a bit of an ethical angle, I suppose, to this. As part of the application process for that particular funding, one of the things you have to effectively self-certify is that your business has been adversely affected. Having said that, the advice and guidance around what adversely affected means is a bit woolly. It doesn't say you've got to have lost 20% of your income or whatever. It's really looking at the circumstances of it. I mean, adversely affected can take various forms: loss of business for a short period, closing premises, furloughing staff. Are you sort of incurring extra costs because of the whole safety aspects going forward that we're all having to operate it under? These are all sort of considerations, I think, to bring into it when assessing whether you have been adversely affected or not. In fact, I've got the question in front of me, and it's sort of to actually say, I don't think my business will be that affected by Corona over the whole financial year.
Yes, in the future,
That stump to me implies that it's been affected. But ultimately, it's a personal thing that you're certifying. I would strongly suggest if you reach that conclusion, it's at least worth documenting why you came to that decision, because these claims can be audited by HMRC at a later date.
Okay, thanks, Chris. I'd like to wrap things up there, really. Just a question for me, asked obviously tongue-in-cheek. How is Rowley coping with lockdown and furlough? Rowley, for those of you who don't know, is the name I've given my roller banner that goes everywhere with me. He's in my home office, but broadband in the actual office is better than the home office, with my teenage boys streaming God knows what on Netflix. Chris has the same issue with his children, I believe. So he's there, I'm here. And as I say, I'd like to wrap things up. If you haven't sort of asked any questions yet, but would still like to, you still can, as I said earlier, using the events@thomaswestcott.co.uk email. We will attend to every question over the next couple of days or so. We've got another webinar next week. It's at the moment it's going to be on the retail aspects with shops reopening and this sort of thing. So look out for that. And finally, I'd like to thank our speakers today, Chris, Andrew, and especially Sean. It's been great. So thank you very much, guys. And also I'd like to thank you, our attendees. It is great knowing you're out there and hopefully getting value out of the webinars we do. So on that note, I'll say thank you very much again. Have a great rest of the week. And as ever, channeling my inner Ron Burgundy, stay safe, Devon and Somerset. Cheers, guys. Bye now.
Bye.